So we can go ahead and get that going. And then you want to defer the discussion on what we'll do for final review, or you want to go ahead and talk about that at this point? With a small group, we can kind of do whatever we want here.
It's a free lesson. I would love to have final review.
No charge over above what you've already paid. You know, the question is, you know, if it's the three that are here and you guys are all saying, yeah, let's do it, then let's book it at a time that's mutually convenient. If you're just saying, well, Serena, I have some questions and I'm the only one that wants to do it, then I would say we can have that discussion offline, you know, as to when we would do that. But
the only concern I have, I'm worried about the portal. They might take down the Zoom link because
no, I'm gonna tell them to leave that open.
Just bookmark it.
Okay, thank you.
That's what I just like punch it into Google, you know, or your thing, and just mark it as a favorite bookmark. That's how I come to class every week. Just favorite that thing.
And for last couple of days, the GGU website was down most of the time. I don't know about other people, because I tried to get in during daytime. I couldn't get in. I had to go in like 2 o'clock or 3 o'clock in the morning.
Okay, let's not get off on a tangent here. I will tell them to keep the e-learning portal open. Has it closed on you?
Not yet.
Okay, so I'll tell them to keep that open. So that's not going to be an issue. But in terms of, and they were, you know, I tell them like I'm God or something. They understand what's going on with this class and they agree to do that. So, but okay, we don't have to answer that now. I don't want us to get bogged down in that. So think about that, and we'll decide what to do with the, you know, another review session as we go. Okay. So let's just go ahead and take a look. See if I can close this without ending the meeting. And I'm going to start out with module 1. We're going to go through module 1, 2, and 3. So we're going back in module 4. I have some slides actually that I'm going to talk to you about. And then we're kind of would be back to where we had started the whole governmental not-for-profit discussion, and time permitting, then we'll jump to chapter 10, that back end, which was still the government-wide stuff that we haven't looked at yet. Okay, so let me go ahead and see if I put myself in tablet mode, that doesn't destroy the whole world on me here.
Points do you think the non-for-profit was worth? I don't have that written down from last
I'll
time.
put it down in a second, Ali. Just let me I'll indicate in a second. Just let me get my I forgot my stylus. What's that? Okay. All right. Okay. So when we deal with not-for-profit, which is basically these, let me put full screen, sorry. Which is basically these 3 modules here. Okay. This used to be a 10-point area. Now it's more like 5 points. Okay. Now I say that not to discourage you from including module 4, not to discourage you from looking at it, but just to give you a sense relative to government. Government is still what, 15, 20 points. But when you take the 2 together, the common complaint, concern I hear, like on you know, their Facebook Becker FAR group, which I don't recommend you join. I hear a lot of students saying, no one told me how important governmental and not-for-profit was. So they tend to get lumped together because they do end up together constituting 15 to 20 points, you know, 20 to 25 points. The government-wide stuff that we haven't talked about later is probably the very tip top of that. That's why I want to come back to not-for-profit now. We've covered the main part of governmental when we deal with the funds, but I do want to spend some time on government-wide, hopefully here tonight. Question? Okay, good. So let's just come over and let's start to take a look at not-for-profit entities. And when we look at not-for-profit entities, we have three major categories: healthcare, educational institutions, voluntary health and welfare, and then sort of a catch-all other not-for-profits. Now, there could be concern that when you look at this, you think, wow, that means I'm going to have to learn something about the accounting for all of these. And you are, but most of the questions use the same basic accounting. Okay, so we're going to talk about them generically. That's going to be the bulk. And then there's going to be a couple of granular things that we're going to talk about that might be relevant to any one of these categories of types of not-for-profits. Now, when we come over to look at not-for-profit accounting, and this is really pretty good news, they use what? Full accrual accounting. So we've been spending a lot of time modified accrual versus accrual, going back and forth. All of those entities that we highlighted on the previous page there use the same basic accounting. They all use full accrual accounting. And the emphasis is looking at information for the organization as a whole. So we're not going to parse this out into funds. So you sit there and you say, well, John, if they use full accrual accounting, which we've known for a long, long time, and we're not parsing things out into funds, why wouldn't we just sit here and understand what we know about regular commercial accounting for not-for-profits? Well, there are two primary things that differ with not-for-profits. One is the form and content of the financial statements. They look differently because we have a different reporting objective. Instead of having a profit motive, we have donors that you have in your commercial accounting. We have donors that want to see that funds are being used for their intended purpose. I give my money to some sort of animal shelter. I want to see that that money is being used to help animals, right? Okay, so that's going to require a different format, a different structure to the financial reports. And then we have revenue recognition issues, because what happens? We say that we recognize revenue when we earn it in commercial accounting. Here, what's happening? People are reaching into their pockets, handing us resources like cash out of the kindness of their heart, just simply because they believe in our mission. Well, that's going to bring in different revenue recognition rules. So that's going to be another thing we're going to have to get comfortable with. And then how we recognize expenses will also start to become something that we'll have to understand a little bit more about as we go in a little deeper here into some of the later modules. Now, we are falling under the jurisdiction of the Financial Accounting Standards Board. So FASB, as you well know, sets accounting standards for for-profit entities, but they also set the accounting standards for what? For private, not-for-profit entities as well. So when we look up things dealing with not-for-profit, we look in the FASB codification. Now, one thing that you can write down right now, the FASB has cordoned off an entire section of the codification just for not-for-profits. Everything dealing with not-for-profits is found in section 958. 958. So if you get a not-for-profit research question, you can get partial credit right there just by remembering that the first three numbers in that prefix will always be 958. Okay, and that's something that's worth flashcarding. I mean, I typically don't ask you to flashcard section numbers and whatnot of the codification, but if it has a chance of sitting there and just remembering the 958 prefix, I think you're in pretty good shape. Okay, now what they do in the codification is they go ahead and then they break out sections of the codification that relate to different financial statements. Okay, now when we look at not-for-profits, they will prepare a statement of financial position, which is the name for the balance sheet. They will prepare a statement of activities, which is the name for the income statement. And we'll see that they really combine the statement and the statement of income statement, statement of retained earnings into one. And then they will have the statement of cash flows. And notice, guys, we can use what? The direct or indirect method, just like you would in commercial. Now, let's say you got a question on the CPA exam that asks you to do some research, on the statement of cash flows. Well, where are we going to find that? We will definitely find it in 958. And then the next area we'll look into is 230, because 230 is the area where all statement of cash flow questions are answered. But if you're looking for something specific for not-for-profit, then it's what? 958, not-for-profit statement of cash flows is 958, 230. So they kind of start the codification over after you get into an industry-specific area like not-for-profit in this case. Okay. Now, go ahead and flashcard the names of the required financial statements. And then note that there's an additional reporting that is required. Now, in the olden days, FASB used to say, well, this is a fourth financial statement that is required for not-for-profits. And now they have turned around, and I find it a little bit annoying that they have turned around now and they say, well, you don't have to prepare a fourth financial statement, but we want you to disclose the information that used to be included in this fourth financial statement. And so what they tell us is that a not-for-profit organization must report information about the relationship between functional and natural classification of expenses in one section. And they have one of three ways of presenting that: on the face of the statement of activities, as a schedule in the notes, or as a separate financial statement, which is how they used to do it. So I always call this the Prince financial statement. It's the financial statement formerly known as the statement of functional expenses, but now it doesn't have an official name anymore. So it's just a symbol or whatever. Okay. You guys know who Prince is, right? Okay. Sometimes I got to remember that there's a generational thing going on here. Okay. So you can go ahead and flashcard the different ways. And why don't you put a little note here that says see page 14, and I'll show you how to use that information when we get to page 14. I find it, and that's why I say it's annoying that they used to require it as a separate financial statement, and now they're kind of allowing it to be buried in notes and whatnot, because I felt it was probably one of the more useful pieces of, a very useful, let me put it that way, piece of information that when I looked at a not-for-profit, it was one of the first things I would look at, because I felt that it gives a lot of really useful information. Okay. Okay, good. Now you come over and you take a look at, and we're going to start to focus in on each one of those statements now, starting with the statement of financial position. Remember, that is LIKE, like the balance sheet, right? Okay. And so since it's like a balance sheet, what do you expect to see on there? You expect to see assets. You expect to see what? Liabilities, and then net assets. And they say equity there. Net assets, though, is really more like LIKE, retained earnings. Okay, you don't really have stocks for not-for-profits, so there's no, common stock. There's no additional paid-in capital. So the equity boils down to retained earnings. Now notice, just like you would in commercial, we display the assets and liabilities in order of liquidity, with current to non-current, liabilities, sequence those to nearest to maturity, etc. Okay, so we have our assets, we have our liabilities. We're going to display those in order of liquidity, in order from current to non-current. And then you come down to our net assets, which is like retained earnings. And our net assets have two categories: those with and without donor restrictions. Now, what happens if we have net asset without donor restrictions? What happens there? That means that they are not restricted by external donors. external donors, okay? The donor outside of the organization has not put any restrictions to the use of those assets that they provide to us. Now, that doesn't mean that the not-for-profit can go out and spend them on things outside of their charter. What it means is the donor has not called out specifically within the organization how those should be used. Now, common exam trick, they love to do this, guys. They'll tell you that there was no donor-imposed restriction, but the board has decided to somehow restrict those funds. Flashcard that those are still considered without donor restrictions. So just because the board has said, you know, say Serena gave some money to the not-for-profit and said it's not restricted, and the board said, well, we're going to use those money to provide scholarships. Those monies are what? Still not restricted. They are still not restricted. Okay. Only donors can impose restrictions. Okay. So why don't you go ahead and write that next to net assets with donor restriction, put down only donors can restrict. Only donors can restrict. Okay. And when donors restrict, they are external. Okay. And those are imposed limitations by who? By the donor. And I know that I'm starting to get annoying with that, but I want to make sure we don't get in that trap that we start thinking that the internal board can restrict the use of assets. Now, when donors impose restrictions, some examples, okay, is a support for particular operating activity, investments for a specified term, use in a specified period, acquisition of long-lived assets. Note that these sort of restrictions are what? Are more temporary in nature. Now, back in the olden days, they used to call those assets, net assets with restrictions, temporary versus permanent. They got away from that. Now they just call them what? With donor restriction. That includes those that are more of a temporary nature and those that are more of a permanent nature. Okay, these are more permanent that you see on the next page. And let's look at those assets that are used for a specific purpose and not sold. So what happens? I donate a building and I say, you're going to use that building forever in this not-for-profit and it cannot be sold. You're going to hold this piece of land forever and use it as a park for a dog sanctuary or something, and it has to be held forever, whatever it is. Okay. And then sometimes maybe I'll give a stock. And I'll say, you know, you have to hold the stock forever. And you're like, well, thanks a lot. What am I supposed to do? Just look at it? No, I may say any earnings or increases in fair value of that stock. And I may impose a temporary, more temporary type donor imposed restriction on that, saying the earnings have to be used for some purpose. Or there could be no donor imposed restriction on the earnings. I'll say, use the earnings however you want and not for profit. But the corpus, the principal, the stock, whatever, has to be held forever. Okay. Okay, good. So we understand that when we look at our statement of financial position, we're going to have what? We're going to have a situation where we will have both donor and those with and without donor restrictions. Now, let's just go over and let's look at the statement of financial position. And I'm going to come back to some of those couple other things in a minute. I don't know why Tom did things in the order he did there, but we have what? We have our assets, and guys, it's current and non-current. Okay, we are not dealing with governmental funds where we just had the current assets. So it's current and non-current, right? We have our liabilities, both current and non-current. Okay, just making sure we understand. And then the primary takeaway here is the net assets, and the net assets are with and what? And without donor restrictions. Okay, so I think I highlighted over to the wrong side there. Without is 92.6. With donor restrictions is 193.490. Now, let's take a look at that 193.490. Okay, circle that and draw a line over to the facing page. Okay, and when you come over back to the previous page, you see that same number, don't you? 193, 490, you see that same number? Okay, and so what's happening here is they're talking about a supplemental disclosure related to assets with donor restrictions. And notice all they're doing here, guys, is they're pointing out to you the types of restrictions, okay? Expenditure for a specified purpose, okay? Subject to the passage of time. Maybe they give me a CD and they say you have to hold the CD till maturity. When it matures, then you can cash it in and use it for whatever, right? Subject to spending policy, okay? Now, for example, we may have an investment in perpetuity, and that means invest forever, but you can spend certain amounts in accordance with state requirements, or maybe they're going to allow me to spend the earnings, something like that, okay? Or they'll say, after a specific event, I can use that, or it may be more permanent in nature, saying you can't ever spend that money. So all they're doing in the disclosure is giving you a sense as to the nature of the donor imposed restriction, right? Is it something they can use for a program? They have to wait a certain amount of time for a certain event. Maybe they can't ever spend that. Maybe they have to hold the principal, but they can spend the interest, and you'd be able to pick that up from that supplemental disclosure. Now, when you come and continue on with these supplemental disclosures for net assets now without donor imposed restriction, and notice that they give me this number 92,600, and then they start telling me something about some of that money, but they're giving you some information that is now helping you to come up with an understanding as to that unrestricted amount, right? They're not unrestricted, but without donor imposed restriction. Question. Okay. Okay, good. So let's come over then and let's take a look at a couple of our first questions for tonight. And notice, guys, I did have you flashcard the names of the statements that are required for not-for-profit organization, because I don't want you to miss an interesting question like this, where all they're asking you is the name of one of the statements, okay? And if you don't have that flashcard, you missed this question, right? So let's just go ahead and let's put that poll up. Okay, and we're maybe going to have a little more efficiency tonight because it looks like everyone has gone ahead and tried that one. Okay, and again, I had you make that flashcard because it is easy to get confused on this. Most of us got it correct, or two of us got it correct out of the three here. But when you look at this, we have what? We have the statement of financial position, statement of changes in financial position. It's not called that, it's called what? Statement of financial position. We don't have the word changes, right? Okay. Statement of cash flows, yes, we saw that. We had to prepare that. So be careful, guys. Don't read first choices and say, okay, get this thing out of my face. Because if you read the second choice, you would have said, well, wait a minute, they do have to prepare a statement of cash flows and you can't have two right answers. So there must be something wrong with A. We don't call it the statement of changes in financial position. We call it what? Statement of financial position. Okay. Okay, good. Let's look at number 2. So make sure you read through the answers. I don't care if the vision of, CPA gods come down and start nodding to you that that's the right answer. Still continue to read the rest of the question, rest of the choices. That sometimes will unveil to you that you maybe misread the question a little bit. Okay, good. Looks like everyone got this right. I could see when Allie selected, her dog's tail started wagging, so he must have known that she got it right too. So yeah, everyone got this. If there's no donor imposed restriction, which was the case in this question, then what? Then that would increase net assets without donor restriction. Good. Question. Okay, good. Let's go ahead then and let's take a look at our next statement, which is our statement of activities. Statement of activities is the name of the income statement. So don't call it the income statement. It is like the income statement, though, but we call it statement of activities. Now, what happens with the statement of activities is we're going to be reporting the change. Okay, change means how did my retained earnings change? Well, what changes retained earnings in a period? Our net income minus any dividends, but since not-for-profits don't really pay dividends, then what? The change in net assets in a not-for-profit from period to period is going to be caused by whatever the net income is, right? But when you report that change, you're going to report it in total, but you're also going to report it by category of net assets, which is those with and without donor restrictions. You add those up, the sum of those become what? Become the total. So maybe we should have put the total there last. Okay. Okay, good. Now you come over and you take a look, and we're going to see that not-for-profits will be getting resources, and generally the 3 broad categories on the statement of activities is revenue, gains, and other support. Now, when we talk about revenues, okay, you want to be careful because that gets a little bit confusing because you're like, well, revenue should mean that you earned it. Well, sometimes it means that you earned it, but other times it means that it's a contribution, okay? But typically what they'll do is they'll put the word contribution revenue in front of that as opposed to some sort of earned revenue like fee revenue or something like that, okay? So you come down and we start to talk about the different types of revenue. And you could have fee revenue, but you could also have what? Contribution revenue, and then you can have gains and losses on investments. Okay, so we have an investment, the investment increases in value. We're going to take that increase in investment as something that will show on the income statement. It's not like we're going to be having held to maturity securities and that kind of stuff. Everything runs through what? Through the income statement. We don't have this issue of available for sale securities and that kind of thing. Okay, so everything is treated like a trading security. Everything runs through the income statement. Okay, now you come over and when a contribution is received, it would come in with or without donor restrictions, okay? And all restricted revenue is included in the same classification, regardless of whether the restriction is permanent or can be satisfied by the not-for-profit. In other words, it's temporary. It all falls under the, and I'm doing this because we're going to see that there are literally columns on the statement of activities where we'll show those with donor restriction, those without, okay? And when we look, the contribution could be subject to a specific purpose, passage of time. It could be restrictions that are somehow otherwise temporary in nature. For example, they may say, here's a contribution, you have to use it to acquire equipment or something. And then there are some times where we have an endowment that is more what we have to hold that in perpetuity. And sometimes if it's a stock or something, maybe the returns will be available for spending, and that tends to be a little more permanent in nature. But again, we consider all of those, whether they're more temporary or permanent in nature, they all fall under the same broad category as those with donor imposed restriction. Okay, now what I'm going to do is I'm going to co-op this space as best I can that falls into
You're right there.
excuse me,
Is that disbursement?
permanent.
Thank you.
Permanent. Permanent. Okay, so what I want to do is try to use this space down here at the bottom of this page into the top of the next page to give you an example of a statement of activities. Okay, SOA, statement of activities. And I'm going to do a statement of activities for this entity that I'm making up called Save the Canines. Okay. And what I'm saying with this Save the Canines is it's a not-for-profit organization that finds stray animals and maybe finds them a home or something. Okay. And so what I want you to do is go ahead and just write down what I'm putting here. Follow along with me as I go ahead and make this note here. Because when we get questions that deal with the statement of activities, the approach that I'm going to tell you to take is to actually make in your notes as you're trying to solve that question, make up a little statement of activities, and that's going to typically help you answer the question. Okay, and I'll show you that when we actually look at some of the questions. So I'm going to do this, and I'm going to do it for 2021, and then I'll do one for 2022. Okay, now what happens? We have contributions that come in. This is a little example of the statement of activities. Contribution that comes in, and the contribution can come in what? Without donor restriction, or what? With donor restriction. It can come in with donor restriction or without donor restriction. That says with donor restriction or without. Contribution can come in with or without donor imposed restriction. Okay. Now we've got this not-for-profit Save the Canines. Does anybody want to contribute to Save the Canines tonight? That's a question.
Yeah, sure. $100.
We only accept contributions in the denomination of 10,000 because that's the example I've memorized. So, Serena, you want to give 10 grand?
Yeah, on my account, yes.
Okay, I don't know what that means, but okay, 10,000. Thank you. You can write me a check later. Okay, so we've got what? We've got a contribution of $10,000 that comes in. Okay, now what happens? We look at expenses. Oh, of 10,000 that came in. Sorry, guys, erased that, crossed that out. Serena, you're going to use this money for the, you tell us you want us to use this money for the Fluffy program. In the Fluffy program, we take money, we buy doggy shampoo, we maybe buy doggy, hair dryers or something like that, some equipment, whatever, to help get the dogs nice and fluffy, because no one wants to take home a mangy dog, right? So we figure we clean it up a little bit, then somebody will be more willing to take it, because our purpose is to what? Is to go ahead and take money and take stray animals and find them a home. So we need to, kind of clean them up first, right? When I used to first do this example, I was kind of thinking I was inventing an organization. Now there are lots of one that's I donated to when my dad passed his pension. Said, hey, do you want to? We'll make a contribution to a not-for-profit organization in your dad's name, and every time one of those commercials would come on where they show the animals, being abused and that kind of stuff, and homeless and stuff, my dad would say, I wish they'd quit showing this shit. I don't want to see these animals feeling like this. So I figured it was okay to go ahead and ask them to give some money to an animal shelter. And the one that I did was the North Shore Animal League. And what they do is they do exactly this. They find dogs and clean them up and find a home for them and stuff, and use different vehicles to let people know about these animals that need a home. So let's say Serena gives us this money, but we don't spend any of it. Well, if that's the case, not a trick question, how much are our expenses?
0.
Good, 0. And then we're going to have to report what? Change in net assets. Remember, we said that's what the statement of activity is supposed to do. It is supposed to show what? Those with and without donor restriction. And I'm not showing the total, but then we'd add those two columns together and there'd be a total column as well. I'm not going to write that down. Okay, and so what happens? What's the change in without donor restriction?
0.
0. Good. What's the change in with donor restriction?
10,000
We're up
increase.
10,000. Good. So when we look at the statement of activities for Save the Canines for 2021, we see that, hey, you got a contribution, you had a donor restriction, and you haven't used any of those funds yet. Okay. All right, good. Then we go ahead and we jump into, and now I'm going to go ahead and do 2022 statement of activities for Save the Canines. I'm not going to write Save the Canines again. We know who we're dealing with. Okay, and we're going to have what? Contribution. Contribution can come in without donor restriction or with donor restriction. Now, what happens? In 2022, we don't get any contributions. So what are our contributions? Not a trick question.
0 and 0.
0 and 0. We don't get anything. Okay. But Michael, we go ahead and we use some of that money, and we use some of that money as Serena told us to, which is for what? The Fluffy program. Okay. When that happens, we must show, I don't like that color. When that happens, we must show a Come on, John. We must show a reclassification adjustment satisfaction of program. Because we satisfied Serena's requirement. Let's say we spent, I don't know, $6,000 of that money. Okay. So when we do that, we have to show the $6,000 coming out of the with donor restriction and coming into the without donor restriction. Then, and I apologize that we're going to run into having to write down into this print here. Then we report the expenses, and our expenses are how much?
Is that the difference? 4,000?
No. How much did we spend?
0, nothing.
Okay, guys, you gotta listen. We spent $6,000 on the fluffy program. So how much did we spend?
6.
6,000. So our expenses are what? 6,000. Okay. And now when we report the change, in net assets. Okay, how much did the unrestricted, without donor restriction change?
0.
0, good. It did what? It went up by 6 because of the reclassification adjustment. It came down by 6 because we spent that money, didn't it?
Mhm.
Okay, how much did the with donor restriction change?
Went down by 6.
Came down 6,000. And then what?
So I have a question. So do we not ever show expenses in the WIS donor restrictions then?
We do not. The only time you're going to show something in the with donor restriction category is if there was some sort of accounting loss that depleted the value of an asset with donor restriction, that it wasn't required that it would first go against any with donor restriction, and then any additional amount would go without donor restriction. So it's very rare.
Okay.
It's very rare. There could be some sort of rare loss that might come out of that, but expenses are always by definition, Michael, under the without donor restriction, because if we're spending the money, we've met the donor's requirement. So we releasing it from that restriction. And so I often give the analogy of 2 bathtubs. Okay, one doesn't have a drain. The without donor restriction doesn't have a drain. If you want to get money, the with donor restriction does not have a drain. If you want to get money out of there, you have to run a pipe that goes from what? From the with donor restriction to the what? Without donor restriction tub, and the plug that releases it is what? From the total net assets is the without donor restriction category.
Okay. That makes sense. Thank you.
Okay. Now, this is important because what happens is on the exam, they'll do things like they'll say to you, and they'll tell you the whole story. They'll say, and then they'll ask you about one part of this. So they'll say, Serena contributed $10,000 to save the canines, stating that it is to be used for the fluffy program. As a result of this transaction, what will be the impact on net assets with donor restrictions in 2021?
$10,000.
It
Or the increase is-
10,000.
yeah,
It's sitting there right in front of you, isn't it? It increased 10,000. What will be the effect on net assets without donor restrictions?
Nothing.
Nothing. It's right in front of you. Okay. Serena contributed $10,000 to save the canines in 2021 to be used for the fluffy program. In 2022, Save the Canines used $6,000 of money as the donor specified. What will be the expenses that will be reported in 2021?
Nothing.
It's right in front of you. 0. What will be the expenses that will be reported in 2022?
6,000.
It's right in front of you, 6,000. What will be the change in net assets without donor restrictions in 2022?
0.
Zero, it's right in front of you. What will be the change in net assets with donor restrictions in 2022?
Negative
Goes
six-
down.
Huh?
negative 6,000.
Decrease 6,000. What will be the amount of reclassification adjustment reported in 2022?
6,000.
6,000. Okay. So all they're asking you with these questions is, do you understand the mechanics of this thing? That's all that's happening when they ask you those kind of questions. Okay. So when you come down a bit here, and I know that I've sort of scribbled all over this a little bit, but when a donor restriction is satisfied, a reclassification is reported on the statement of activities. Reclassification adjustment items are items that simultaneously decrease one class of net asset, those with donor restriction, and increase another class of net asset, those what? Without donor restrictions. Isn't that what that reclassification adjustment just did? Okay, so that's all that means. And you know, I don't think FASB or Tom, and I don't know why he writes it like that, because he's writing a textbook. He could have been a little better in how he explained that there. I think he just lifted that right out of the statement here. He should have been more specific. That's what that means. It'll do what? The reclassification adjustment decreases those with donor restriction and increases those without donor restriction. Okay. Okay, good. Now you come over and we have expense classification. And expense classification will be by category, either program services or support services. That's it. When we classify our expenses, they are either considered program or support. Programs are things NFPs do. If you are a university, can you think of a not-for-profit university? Can you think of one?
GGU.
Golden Gate, Stanford, okay, is a not-for-profit, okay? Although you have to have made a lot of profit to go there, the university itself is not-for-profit. Okay, so what happens? Education would be the purpose of a not-for-profit university, hospitals, patient care, etc., right? Fundraising are things NFPs do to survive. For example, what? To survive, how do we spell survive? For example, what? Fundraising. Do you think Save the Canines is going to last very long if they sit in a holding pattern like we saw in the 2022 scenario? Maybe that's why you guys were having trouble. I think I started bringing 2023 to some of my theoretical questions when the years were 21 and 22. We wouldn't be able to answer anything about 23 from this, right? Do you think they'll be able to last long in 2022 if they stay like this?
No.
They need money, man, to survive. Okay, it's always kind of makes me laugh with not-for-profits that I've been involved in. You raise money, and then here comes everybody with ideas how to spend it, and I hear nothing again about how to raise any more money. And I'm always like, hello, this won't last, right? So that to survive, you need some fundraising, right? Management in general, right? You need to pay your administrative expenses. Now, we don't want those administrative expenses to be, ridiculous, but yeah, we got to pay people to run the organization. Membership development. Hey, not-for-profit is not going to have much influence if it doesn't have members. Okay, so the two broad categories are what? Support services, program services. Program services are things not-for-profits do. Support services are things not-for-profits do to survive. But why don't you go ahead and add another flashcard there that calls out specific examples of support. Okay, now you could have combined costs. Okay, now what do we mean by combined costs? Well, let's say when we're trying to, find the dogs a home, we realize that a lot of time the reason people sort of don't take care of the dog, they get rid of the dog, is whatever. The dog is cute when it's a pup, it gets big, and now it needs some, care, like doggy grooming, right? So we think, why don't we put on an educational program that teaches people how to take care of an animal that they get. So we go and we spend some money, on a dog actor. We spend some money on a groomer who will be able to present and teach the class. We need a space for the class and whatnot. And so we come out and we say, hey, look, we want to have somebody pay for this class. Okay. Now, what happens? We have this class and people come up to us and they say, well, we're willing to pay for this class, but we're going to give you $100 for the class. And we say, come on, give us 1,000. We're trying to help dogs here. Well, if we spend, say, 10,000 on the class, that'd be a lot to spend on the class. Let's say we spend 5,000 on the class, okay? And somebody ordinarily would be willing to give us $100, and we get them to give us 1,000. Then how much of that money is an education program versus fundraising? And so what we would probably do is say, well, look, the fair value of the class was 100. We got people to do what? Give us 1,000 for that class. So that means that what? Of the 5,000, whatever we spent on that class, 10% of it, or what? 500 is what? Program. The remaining what? 4,500 is actually fundraising. And so when you combine program and what? Fundraising, you have to figure out a way to allocate those costs between the program versus the fundraising component. That's all they're telling us there. Question? And it doesn't have to be the way I said, just some systematic way of doing that. Okay. All right. So now we look at that statement of activities. Okay, here it is. And we have revenues, gains, and other support. We have what? We have contributions. The contribution come in with or without donor restriction. Now look, their statement is a little more busy. It's not just one contribution coming in, but it's pretty much what we saw in our little example, right? Then what? Sometimes we have some fees. Fees are by definition considered without donor restriction. For example, go back to the doggy grooming example. Let's say some people come up to us after the little seminar of the combined cost thing where we're teaching the doggy grooming, and they say, hey, I want to take this dog home, but I want to take a dog home, but I know I'm not one to do doggy grooming. I'm afraid when I go to clip the nails, I'm going to hurt the animal or something. Will Save the Canines do the doggy grooming if I, take a dog home? And we say, hey, that's an idea. We're going to charge you for that. But yeah, and we start doing doggy grooming and we charge somebody $100 for that. We say, yeah, we're charging you that. And the person says, well, I'll use it, but I want you to use this money for the fluffy program. And they can't do that because it's an exchange transaction. There is what? Fee for service. Those are by definition unrestricted. Okay, notice there's nothing in the without donor restriction. There's nothing in the with donor restriction category. Okay, you have different other things going on here. Investment returns could be with or without. It just depends on whether the donor said returns have to be used for a specific purpose, or they may say, hey, there's returns on this, hold the principal forever, but the returns on that you can use however you want, or you have to use it for a specific purpose. Now notice that we get down to the assets released without restrictions, and notice, just like we saw in ours for our satisfaction of program, it came what? Out of the with donor restriction and into the without. And I always feel like I'm doing some weird poetry there. Out of the with and into the without. Okay, so it comes out of the with and into the without. Notice it also works for what? Satisfaction of equipment acquisition. Okay, expiration of time. Now, these three that are being shown here are what? Are pretty common ones: program, equipment, expiration of time. Okay, so you can maybe give yourself a mnemonic for the typical types of programs that not-for-profits have: program, equipment, and what? Time, the different types of restrictions, I should say. Okay, pet, put your pet in a not-for-profit, save the canines. Okay, now notice, guys, and I do see some annoying questions where they start giving you all this information about with and without donor restrictions and the different categories, and then they end up asking you what? The total. So if they gave you a bunch of information about the individual pieces, be careful if they say what will be the total revenue gains and other support. They're not asking you about with or without, they're asking you about the total column. So be careful you read the question carefully, right? What are they asking you? They're asking you about one of the columns or the totals? Are they asking me about one of the line items? Or are they asking me about the total of the line items? Be careful with that. That's a common CPA question. They're testing there your attention to detail more than anything, right? Okay, and that would that logic would follow for any part, not just not-for-profit. Okay, now you come over programs, our expenses. Notice they're all coming out of the unrestricted, though without donor restriction. That's our program, obviously. And then we have what? Management in general and fundraising. That is what? Support. Examples of our support. And then, Michael, you know, you have some of these weird things there. It comes out of the with donor restriction because there's some sort of actuarial loss, but you start getting into sort of almost, you know, very granular kind of Martian kind of things there. When you start dealing with that, I don't think the examiners are going to get off too much into that. Okay, and then you have the net asset, you have the total change in net assets. That's like our net income, we reported with and without in total. Okay, and then we give the net assets beginning, and I think you recognize what those end of year numbers that flows over to the statement of financial position, the balance sheet, right? We looked at those numbers earlier. Okay. Okay, good. Now we come over and let's take a look at reporting expenses by nature and function. Okay. And we're going to report them by major classes of program or support services. And then we're going to have natural expenses, for example, salaries, etc. Now, this used to be a separate statement. Now they are just requiring it to be a disclosure. Okay. So what I want you to do, notice we have program, we have support. Okay. Now what I want you to do is I want you to come over, and do you see Alpha program here? Do you see total expenses of 13,296? You see that number? Okay. Come back to the statement of activities. Okay. And on the statement of activities, when we look at our program Alpha, we see that they did spend 13,296, didn't they? Okay. Now you come over to this 13,296. And you come back, and now you can look at this and see, well, what did they spend it on? And you can see that, okay, a lot of this was spent on salaries and benefits. Okay. A good chunk of it is what? They give money to other organizations. Now you may look at that and say, well, I don't know if I like that. Who are these other organizations? I'm giving my money to save the canines. Meanwhile, they're turning around and handing that money to somebody else. That might be something that you learn from this. Okay. Now, what I like to look at is the fundraising number in the support. I like to look at that number when I look at not-for-profits, because what I have seen in the past, I had a colleague that was on an assignment, former GAO guy, moved to the city of San Jose. He gets on an assignment where they're looking to see how a not-for-profit that received money from the city of San Jose, how they are spending the city's money. And he's like, hey, can you come over to our office and help us take a look at this not-for-profit's financial reports? Because we're seeing a bunch of stuff we don't understand. I said, you buy me lunch? He's like, of course. So, okay, I'll be there. So I go down to San Jose. I look. The first thing I say in those days, it was an actual statement that they called the statement of functional expenses. Is let me see the statement of functional expenses. And I look under fundraising, and I see under fundraising that they're spending money for contractual services. And I'm like, what is that? Why are they spending money on these contractual services? Well, they're spending this much on contractual services. And then when you look, they were spending more money on the contractual services to fundraise than was being raised. That is ridiculous. Okay, that should be a multiple, depending on the not-for-profit entity, of something of 7 times the return. You shouldn't be sitting there and having a situation where you're spending more money on fundraising. In other words, what? Somebody was in the back pocket of that city, you know, and of that not-for-profit, getting money from the city, and then turn around and handing it to, you know, their cronies, right? And so that was one of the major findings of that work. Said, you're pretty much done. You can start slapping these guys around at this point forward now that you got this. So that I feel, and that's what I don't like about the fact that FASB buried this thing back now in the footnotes, and on that I thought it was one of the most informative statements. Okay. All right. Question. Okay, good. Let's come over then, and let's just take a look at a couple questions here. Where's my poll? There it is. Now remember, guys, they're asking me about net assets released from restrictions here. I'm going to shut up in a minute. They're asking me about net assets released from restrictions. Where is that reported?
That's the it's the one that's like the income statement. Sorry.
Statement of activities. It's on the statement of activities. And so when you get a question in which they're asking you about something that's going to be reported on the statement of activities, the approach is to do what? Make yourself up a little statement of activities that describes the whole set of what happened, and then choose the correct answer about the one thing they're asking you about, which is net assets released, right? Okay, with that little bit of coaching, I'll shut up. Okay, looks like all of us have had a chance to make a choice on this, and okay, we're a little bit spread out here, but I think once I show you how to attack a question like this, you'll be in good shape for the next one as an example, okay, where we're going to take the same approach. All right, so since they're asking me net assets released from restrictions, okay, the answer here is C. Since they're asking us net assets released from restrictions, I'm going to make myself up a little statement of activities right here. I'll put this on my scratch paper, and I'm going to have what? Contribution. And I'm going to have without and with donor restriction. I'm not going to write the word donor restriction. With and without, right? Okay. Now I start to read the question. It says at the beginning of the year, Baker funded non-governmental. By the way, guys, the reason they say non-governmental, not-for-profit, there are governmental not-for-profits, but they fall under the purview of the GASB. And we've already talked about what they do because they do the same thing state and local governments do. So, for example, San Francisco State would be considered what? Universities can be for-profit. They can be what? Not-for-profit in a private setting, Stanford, Golden Gate, or they can be what? Not-for-profit in a government setting, which is, for example, San Francisco State, San Jose State. Okay, so the government not-for-profits fall into all three categories. Now, we come over and we take a look and we have this 125,000 restricted to youth activities. So does that have a with donor imposed restriction? Right, 125,000 comes in. During the year, youth activities generated 89,000 of revenue. Okay, well, if I have revenue and it's for a program, what should I do? Where does that show up? I charged a fee for a service.
It'd be without restrictions.
That's without restriction, because we said if you are charging a fee, that goes into the without restriction, right? That's an exchange transaction. Good. Then they said that we had program expenses of 95,000. Now, guys, don't start getting into the business of getting creative at this stage of your life, okay? You decided to be an accountant. So don't start writing stories, and fictional things. Nowhere did we talk about, well, first use up any amounts of without donor restriction before you start using amounts with donor restriction. We didn't say anything like that. We didn't say that. We said when you meet the donor's restriction, reclass out of with donor restriction and into without. Isn't that all we said? And so you met the donor's requirements because you used the money for the program, didn't you? Okay, so when that's the case, we have the reclass, in which we do what? We have the money that comes out of the with and into the without. And then, of course, even though it wasn't necessary to answer this question, we'd show the expenses here of what? 95,000. So notice they told me the whole story, but then they just focused in on what? The reclass section, the amount that's shown is being released from the donor imposed restriction. That's why you need to sit there and do this every single time. And the reason I say that, I had a student who was having real trouble with not-for-profit. And she says, well, can you help me? I don't understand what's going on here with the statement of activities. So we went through every single question in the homework that dealt with the statement of activities. And I think we answered 90% of them doing this. And once she got good at this, it was no longer a problem. Okay, so take this approach. Okay, good. Let's look at question 4 then. See how we do with that. Okay, let's go ahead and take a look at this one. And just about everyone got this one right. So let's take a look. Choice, the correct answer is A, but let's go ahead and let's look at this and let's see if again that approach of preparing our own little statement of activities will help us with this. So in its fiscal year ended June 30th, year one, Barr College, a private institution, received 100,000 designated by the donor for scholarships for superior students. So what happens? Well, if we prepare the what? The 630 year one statement of activities, we have a contribution that comes in. We would have without, we would have with. This one comes in what? With the donor restriction of 100,000. Okay, and that's what happened. Let me get this poll off of that screen here. Okay, so we have that 100,000 that comes in with a donor restriction, and that's for the year ended 6/30 year one, right? Okay, then we go and we have what? We have, and what they asked me about is for the year ended 6/30 year two. Now, year two begins what? July 1st, year one, and runs to June 30th, year two. Okay, so the thing that made this complicated was the fiscal year, right? Fiscal year one ends June 30th, fiscal year two begins July 1st, year one. So it's not until what? It's not until fiscal year two that they decide to what? To actually go ahead and meet the donor's restriction. Okay, so what'll happen? We'll have a reclass. And in year two, what'll happen? That money will come out of the with donor restriction, go into the what? Without donor restriction, and then we'll show expense of 100,000 because we're spending that money the way the donor stipulated, giving the scholarship. Okay, so when we look at the choices, is it true that the without donor restriction both increase by the reclass and decrease by the expense? Okay, now outside of the fiscal year thing here, I could have put the original Save the Canines example in here. Save the Canines received a contribution from Serena of $10,000 in year one. In year two, Save the Canines spent $6,000 the way Serena stated. As a result of this, what would be correct? And there would be what? Both an increase and decrease of $6,000 in net assets without donor restriction. Same exact thing we did, isn't it? Just a different set of words. And of course, they put in that annoying fiscal year thing in there. Okay. Okay, good. Let's go ahead and take a look at this next question. Now, this one's not going to require the statement of activities. They're simply going to ask us, how should we classify our expenses? Okay, good. Everybody got this right. Obviously, what fundraising, sending money to solicit contributions is a fundraising cost, is considered support. The other two are also support, but they're what, more of an administrative cost? Okay, good. Just looking, we've got a natural breaking point here, which is to go ahead and take a quick break. And we will go ahead and we'll pick up module. Oh, okay, we'll still pick up module 2. We'll take the break. We'll pick up module 2. We're going to look at that, which is more mechanics as to how things are presented on our financial reports. And then when we get into where I was going there for a second, when we get into module 3, we'll talk about the recognition, right? So we're really talking about presentation here to a large extent. Pretty soon we're going to start talking about what, which is where things appear on the financial statements. When we get into recognition, that's going to say when things should be included on the financial statements, right? Okay. Okay, good. But let's go ahead, since I already kind of teased you with the break. We'll take the break right now. I'm showing 6:23 so that we don't have a weird time. Why don't we just go ahead and say 6:35, okay, for our break to return. Okay, good. So let's go ahead and let's take a look now at the statement of cash flows. And as we saw from that question earlier, class question we did together, statement of cash flows is required for all not-for-profit organizations. And they tell us here that it is contained in FASB Accounting Standards Codification, section 230. But again, you would first look where? First look to 958, then you'd look to what? Then you would look to Accounting Standard Codification section 230. Okay, so everything about not-for-profit is found in 958, and then you kind of start the codification over. If you were looking for something just about statement of cash flows, not specific to not-for-profit, then you would start with what? 230 in your search in the codification. Okay, and you will have, as part of your task-based simulation, they will expect you to do research, right? At least one. By the way, were we able to get registered for the class? I know there was a question last time and a name was given. As someone
I did. Yeah, she got back to me right away. So
Okay.
someone sent me her email, so that worked out good. Thanks.
Okay, good. Thanks. Yeah. Okay, now let's take a look. And the statement of cash flows, as we studied together, is going to show operating, investing, and financing activities. And note that for when we talk about government, we're going to see that government entities have to use the direct method. For not-for-profit, it is okay for them to use either the direct or indirect method. And we talked about both of those when we talked about statement of cash flows in an earlier chapter. So when we look at operating, okay, when we look at operating, we have what? We will report activity by major class, okay, using the direct method. So if it's, you know, cash received from donors, that sort of stuff, if we're using the direct method, okay, receipts of unrestricted resources go into the operating section of statement of cash flows. Okay, cash payments to suppliers, again, if we're using the direct method. Cash payments for interest would be shown either directly if we're using the direct method, or would have to be disclosed somewhere if we're using the indirect method. So you can go ahead and flashcard here that if we have unrestricted resources that come in, okay, without donor restriction, that is considered operating activities on the statement of cash flows. Now, when we come over and we look at investing activities, okay, and you take a look and we say that investments in property, plant, and equipment, nothing major there, guys, just like we talked about for the for-profit version. Proceeds from the sale of work of art. Yeah, okay, that's something that's probably a little unique because most entities aren't going to sell works of art, but maybe a not-for-profit museum or something might have an approach where they're able to sell some things, get some money, and buy other items, right? Proceeds from the sale of assets that were restricted in the prior period and whose sales or proceeds were restricted to investment in equipment. Now that gets a little bit interesting because if you come down, notice they tell us that receipts from contributions restricted for the purpose of acquiring, constructing, or improving property, plant, and equipment or other long-lived assets, and that's down here under financing. So why don't you flashcard here that money comes in that is restricted, comes in as financing. And then when they go ahead and they spend that money, now they got the money, came in as financing, and now they spend the money the way the donor told them, they sell those assets later on. So they spend the money the way they were told, they make the investment, and then if they sell that, that money comes what? Comes out as investing. Okay, so I get some money and they tell me, okay, here's some money, spend it for long-term purposes. I do what? I buy the equipment. Well, that's going to be showing as what? Investing activities when I buy that item. And then if I later on sell that item and they say that money is what? Restricted for long-term purposes, then what? Then I'm going to go ahead and I'm going to show that as proceeds from investing. So it can be a little bit cumbersome. It comes in as financing, goes what? Goes out as if I spend it, it goes out as investing. And then if I sell that item and I get cash back, that's considered investing. Okay. You take a look and we say receipts from contributions restricted for the purpose of establishing or increased donor restricted endowments. So now they give me money and it's restricted. Okay. Now, this gets a little bit funky. I mean, it'd be nice if the sort of rule of thumb here was what? Money's restricted, it's operating, money is what? Financing, it is considered, money is restricted, is considered financing. And of course, as we invest, that's investing, right? Okay, now, unfortunately, it gets a little bit funky. And the reason it gets a little bit funky, because I don't want to use bad language here, but if you come over here, you take a look and you see this change in net assets, 15,450. Okay, so are we using the direct method or indirect method here? Change in net assets is like what? Are you speaking, Nina? I think you're muted.
Of a net income.
It's like net income. So are we dealing with the direct or indirect method here?
Direct. Right?
Try again.
Oh, indirect.
Indirect.
Indirect method starts with net income, doesn't it? Right? Okay, now this is why I don't like the indirect method because it starts bringing in all kinds of weird complications that I don't find very helpful. Look, if a user of the financial statements knows that the operating income is displayed on the financial reports, then why can't they just roll with having it start with operating income and then what? Reconcile to cash provided by operating activities? Hello, why do they have to go to net income? I don't get it. You know, FASB needs to take a look at that. But anyway, they don't, you know, the 7 members of FASB don't come to my house and say, what do you think we should look at, John? But if we go back and you turn back, and I forget what page it was on, I should probably note this. Oh, I did note it. Hello. It's on page 13. Okay. If you go back to page 13, okay, and you look at what? You look at our statement of activities, Okay, on page 13, we had what? We had 15,450. That was the change in net assets for the what? For the with and without donor restriction amount combined, wasn't it? So we have a little bit of a problem because they're telling us to tease out those cash contributions that were for what? With or that weren't restricted or were restricted on the statement of cash flows. So because they did that, you end up with weirdness like what I'm about to show you now on page 15 on the statement of cash flows here where we were. We come over, was it 15? Not 15, but 19.
20.
20, okay. Okay, and so what happens? Because they told us contributions that were restricted for long-term purposes needs to be where? Needs to be down right here. Interest and dividends restricted for reinvestment. It's supposed to be where? It's supposed to be down in the financing, but we have to take it out then because it was rolled in there because that 15,450 included both what? Restricted and unrestricted, didn't it? So now we've got to back it out of operating just so that we can come down and do what? Include it in the financing. Okay, so this idea of starting with net income and the indirect method and that presents some weirdness like that. Now, I don't think the examiners are going to get all hopped up on that because that's sort of a fine point, but I'm just showing you that's how that would be treated. Okay. Okay, good. So let's just come over and let's take a look at this question.
Can you put that poll up, please?
Oh, yeah. Sorry.
What the heck?
Okay, looks like everyone's had a chance to look at this one and good, everyone got it right. Answer here is C, and we have what? We have the amount without donor restriction. That's going to be operating activities, right? And then we have an amount that was restricted for the purchase of equipment. When that amount comes in, it comes in as what? Financing activities. And then when they spend that money, it'll be shown as what? As subtract from the investing. Okay, so the answer here is C. Good. Okay, good. Let's go ahead now and let's turn back to, or not turn back to, but let's look at revenue recognition. And we're saying revenue recognition, but that's somewhat of a overstatement because we're also going to look at expense recognition here as well. Okay, so we've been looking at the structure of the financial reports, right? The statement of net position, which is like the balance sheet, the statement of activities, which is like the income statement. We just looked at statement of cash flows, that other disclosure about the statement of functional expenses. But we didn't solely say, well, what would cause you to recognize the revenue? What are the criteria? Okay, So that's what we're going to start to look at. And they tell us that you have different types of revenue. Now, these are more classic revenue. Okay, these are what? These are exchange transactions. So why don't you go ahead and flashcard that? And again, those are by definition what? Unrestricted. And we typically take these when they are what? Earned, when the service is provided, right? Okay, so that's not really that difficult, but go ahead and flashcard the nature of exchange transactions that are considered revenue, okay? Now, contributions, okay, contributions are what? Are non-exchange. Now somebody just gives me money out of the kindness of their heart, okay? And if it's non-exchange, then we have to look to see whether it would be what, whether it will be even recognized. And if it is recognized, then would it be, if it doesn't have a donor restriction, it's without donor restriction. If it is what? If it is with donor restriction, then it would be in the with donor restriction category, obviously. Okay. So there is what? It's non-reciprocal. There's nothing in exchange. Now, be careful because sometimes you'll see what? You'll see contribution revenue. Okay, that is not exchange. That is still considered what? Non-exchange. It is still considered non-exchange. So even if they call it contribution revenue, it's still what? It's still considered non-exchange. Okay, they just call it revenue for a fee or something that is considered exchange. Okay, now what makes something a contribution? And it is defined as a non-conditional transfer of assets like cash to in a manner which is voluntary. Okay, so when should we recognize it? And it really depends on whether it is, and you come down, a cash contribution or not. Cash contribution should be recognized as revenue in contribution revenue and increase net assets with or without donor restriction in the period in which they are received. So when you get a cash contribution, you don't have to ask yourself anything else. It's going to show up on the statement of activities. The only question is it with or without a donor restriction, like the 10,000 that Serena gave us, okay? Now, if it is a promise, otherwise known as a pledge, it depends on whether it's unconditional or conditional. If it is an unconditional promise, a pledge, then it is going to be recognized as revenue at the time the promise is made. Let's go ahead and flashcard that, okay? So someone says, hey, I promise I'm going to give Save the Canines $10,000. What do? We debit pledges receivable, PR, okay, for what I say, 10,000.
Yeah.
We credit contribution revenue for 10,000. And if that was restricted, like we did in our little example for the Fluffy program, when we prepare our financial statement, we would have what? Contribution with donor restriction, right? 10,000. Okay. Now, if it is a conditional promise to give, okay, and that depends on a specific occurrence of a future uncertain event, recognition does not occur until the conditions are substantially met. So let's go ahead and flashcard that. Let's say now Serena says to me, well, look, I'll give you 10,000, but after you have found a home for 10 dogs. Can I recognize the revenue when I find a home for 1 dog? No. How about 2? How about 6? Can I take 60,000? I can't take any of it until I found a home for what? 10 dogs. Now let's say I find a home for 9.5 dogs. So now I find a home for 9 dogs, and then the last one was pregnant and da-da-da. Well, I'm really finding a home for what? 15 dogs at that point. So maybe I would go ahead and say, okay, I've substantially met that. I don't have to wait to witness the birth or something, you know. So if you have some fine granular things that are going on there, then you can go ahead and take that revenue. Okay. All right, good. Now you come down, and if it is a conditional promise, I've had you flashcard that. Now, conditional promises, you have to wait until you have met the requirement, whatever. Okay. Now you come over oh, that's why I was hesitating there. I did want to say something about this good faith deposit. Okay, if that's the case and somebody gives me a deposit and says, hey, I'll give you the money, I'm giving you the money now, but you haven't really earned it until you meet the conditions, then that's a liability, right? And that's, so we'd have to debit the cash and credit the liability, refundable advance. That's a liability. Okay, good. Multi-year pledges. So what happens here? Let's say someone says, look, I'm going to give you $500, but I'm going to give it to you 2 years from now. Well, I would go ahead and I would book that as what? As a pledges receivable, but I would book it at present value. So let's say, and I'm just going to make a number up, the present value of that $500 contribution is $475, right? It's going to be less than the 500 using the time value of money consideration. So I go ahead and I debit pledges receivable for $475. I credit contribution revenue for $475. Okay. Now later on, when the person pays me, how much are they going to give me? 500 in this example. So the future collections are considered donor restricted contribution revenue. They consider that a time restriction. And the difference between the previous recorded present value and current amount is collected as considered a contribution revenue, not interest income. So flashcard that. And so what will happen? I'll go ahead and I'll debit cash for, we said they're going to give us 500. We credit the pledges receivable for 475, and then we're going to credit what? Contribution for 25 in year 2, whatever, when they finally pay me. Maybe in year 0, they made the contribution, they made the pledge. They waited until it's year 2. I recorded it in year 0 at 475, and then the difference between the present value and the amount I finally collect is considered a contribution. Okay. All right. Let's look at split interest agreements. Okay. And let's say we have a donor and the donor hates their kids. And they say, I'm not going to leave any money to my kids. My kids have not done a good job taking care of me when I'm an old man. So I'm not leaving any money to them. I'm giving all my money to Save the Canines, but Save the Canines, I want you to pay me an annuity for the rest of my life until I die. Here's all my money. Okay, whatever's left after I'm dead, you can have. Okay, so what happens? That would be example of a split interest agreement. Okay, the donation has come in, but it needs to be what? It needs to be shared amongst different beneficiaries, including in many cases, the donor. What I'm describing to you is considered a charitable remainder trust. Okay, so what happens? Assets and liabilities recognized under split interest agreement need to be disclosed separately on the balance sheet, the statement of financial position. So I'd have to show cash, what? Restricted under split interest agreement, right? Okay, on the statement of financial position. Also, contributions and changes in split interest agreement, again, have to have what? A separate disclosure on the financial statement. So when I show contribution, I have to show a separate line item, contribution made under split interest agreement. Okay. Now, just to, and then split interest agreement should be measured at fair value. Okay. And estimated based on the present value of future distributions. Okay, now you can go to flashcard that, but just to help out a little bit with this, I have this supplemental kind of information here. Okay, and let's just look at the split interest agreement stuff here. Okay, which we've seen with the split interest agreement, assets and liabilities recognized under split interest agreements should be disclosed separately, right? And then contributions should be shown what? Separately. Same thing I had you highlight in the book and flashcard in the book is down here. Okay. And then I want to come up, and this one's really, 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 really hard to see. So I apologize in advance for that. But this is one of the best examples I've run into as to how to handle split interest agreement. And so even though this is old, I want to use this example. And it's talking about temporary restriction versus unrestricted. And that's the old terminology. Now we know that what both temporary and permanent restrictions are both considered donor imposed restriction. So an update to this question would have it being called out as a donor imposed restriction. Now try to see this as best you can, but I'm going to read this to you. On December 30th, 2021, Albert Altruistic donated $200,000 to the Carbon Museum under the terms and conditions of a charitable remainder trust that guaranteed Mr. Altruistic a lifetime tax-free annuity of $20,000 per year and bequests the remainder to the Carbon for use in the operation and the furtherance of the mission of the museum. Independent actuaries have estimated that museum liability have a present value of $84,250. I was talking to somebody the other day and I mentioned what an actuary, I was telling them about the movie About Schmidt. I don't know if you've ever seen this movie, and I told them in the movie About Schmidt, Schmidt is an actuary. The person looked at me and says, "What's an actuary?" And I'm like, well, an actuary tells us when you're going to die, tells us when I'm going to die. They look at certain factors, and that's what they figure out, right? And the person looked at me like, oh, you're a morbid person. I'm like, what do you want me to do? That's what they do. Okay. So what happens? We have an actuary, and they've said, this guy's going to live a while, but by the time he dies, you will have paid him on a present value basis $84,250. So what happens when they get that money? They show cash of 200,000, right? They show cash of 200,000. They show the liability for what they think they're going to have to pay them. That cash asset and that liability would be called out as what? Cash that is held under split interest agreement, liability under split interest agreement, right? And then the remainder, the 115,750, would hit the statement of activities as what? As a donor imposed restriction, because we have to wait till this person dies until we've actually earned that, right? And so what happens? We go ahead until we could actually, I should say, use that money and reclass it out as without donor restriction. So we've earned it because we've figured out the difference here, and we can put that in the statement of activities, and it would increase our with donor restricted net assets. Question? Okay, that's the way these charity split interest agreements, like a charitable remainder trust, would work. So let me get out of slideshow mode here. Okay, good. Now come back to the textbook, and I think I had you flashcard the key things there, but I think now you can kind of visualize a little better what's going on with this stuff. Now come down and let's take a look at donated services. So what happens? Well, now rather than give us money, people come to us and they say, hey, I'm going to help out the not-for-profit. Okay. Now, should we recognize the value of donated services? And they tell us yes, they should be recognized as contribution revenue and expense at fair value if the service meets one of the following criteria. They say contribution as an expense. That's if it's a service that does not enhance a non-financial asset. So what happens? Let's say that somebody comes and they're going to build this doggy kennels now. Go back to Save the Canines. And the person starts building us the doggy kennels, and they see what we're doing. They say, you know what? I've always wanted to help animals. I love animals. No charge for this. So what would I do? Well, it's a donated service that did what? Enhanced a non-financial asset, didn't it? This building. Okay, so what would I do? I would debit, building, whatever. Say they charge me $100,000 for that, and I would credit contribution for $100,000 because it met the criteria. It did enhance or create a non-financial asset, these doggy kennels, right? Okay, now let's say it's a veterinarian, and the veterinarian says, hey, I'm not going to charge you for the back half of the year. So they charge me for the first 6 months, January through June. July 1st, they announced no more charge for the rest of the year. I want to make a contribution to Save the Canines, right? Now, let's say they were charging me $1,000 a month for my veterinarian services, because when we get dogs, they have to come in and look at the general health condition of the dogs, whatever. And so what happens? For the period now, July 1st to December 31st, if it's $1,000 a month, how many months is that? 6 months. Okay, so I would take the 1,000 times the 6 months, and I would go ahead and I would debit what? Service expense for 6,000 and credit contribution for 6,000, which is more of what was being described there. They kind of left out, and by calling it as a contribution and expense, and then they start talking about creating a non-financial asset. Well, that's an asset. Therefore, you have to debit an asset account, right? So they were really careful the way they wrote that. Now, so we should recognize a revenue if it other than that enhances a non-financial asset, if it requires what? A specialized skill. Veterinary medicine is very specialized, was otherwise needed and what? Measured easily, and they give you that criteria sum. Okay, now be careful, because I've seen questions where they say it's something like secretarial services. Don't get snooty, guys. Okay, if it's calling out and it's giving a profession, I don't care how you may want to look down on that profession, that is a specialized skill. If it's something like picking up dog poop, then no, that's not a profession, I guess. And so, although these days I hear that people actually pay other people to come and pick up their dog's poop, and I'm just like, okay, I thought that was like, duty number one. If you have a pet, that's your job to pick up the poop, but no, I guess not. Okay, but anyway, something like that, transferring, bags of food from one container to the next, that kind of thing. It's really, they should just say it didn't require a specialized skill instead of making you guess as to whether or not it's a specialized skill or not. But you'll see how that'll work in a lot of these questions. Okay, and again, you can see that what in the case of the enhancing the value of or creating, then you would debit asset. If it is a service, then what? Then you would debit the expense. And in both cases, you credit the contribution, just the way I showed you up there. Okay. Okay, good. Come over and let's take a look at donated collection items. Okay. So let's say somebody gives me a valuable piece of art. I don't know, the original painting of the dogs playing poker. You ever seen this thing where these dogs are playing poker? They give me an original. Okay. And so what happens? Should I recognize the value of that contribution? Okay. And they tell us that we are not required to record that if we meet all of the following criteria. So the item is part of a collection which is held for public viewing. Obviously, guys, this is coming more into what, museum type settings, okay? Then what, the collection is cared for or preserved, and the organization has a policy that if I sell one of the items, then I have to take that money and reinvest it in other collection items. And if I meet all of those criteria, then when I receive a contribution, I don't have to recognize that on the works of art. I don't have to recognize that on the face of the financial statements, the statement of activities. Okay, good. Donated materials. Okay, if it is something that will last for a while, I'm going to debit asset and credit contribution. Okay. If it is something that merely passes through the organization, for example, what happens? I get a donation of clothing, but then I'm going to simply take that clothing and do what? I'm simply going to hand it to, those that are in need of clothing. Then that would be what? That would be considered an expense. Okay. Should not be recorded unless the amount involved is substantial. Let me say that a little better. Okay, should not be recorded unless it is substantial. If it is substantial, then what? Then we go ahead and record the expense. So it has a net zero wash on the financial statement. So you need to look to see how substantial that contribution is. Okay, good. Now, gifts in kind. Now people give us what? Give us stuff. Instead of giving us money, they give us stuff. They give us tickets and those kinds of things. Now, what happens? They give us tickets to the 49ers, let's say, and they give us those tickets, give us tickets to the Warriors, whatever. What are we going to do? Send the dogs to the basketball game, say, hey, go ahead, Fido, Fifi, have a good time? No, okay, we can't really use that to help the dogs. And we keep getting this stuff. So we say, you know what we're going to do? We're going to hold a silent auction. And what we do is we put out these little papers and everyone writes down what their bid is. You serve a little wine so people get tipsy, and the highest bid goes ahead and, wins the tickets, whatever. Okay. So when we first get the tickets, okay, gifts in kind that are donated as part of a fundraising material are valued at fair value when received. Okay. So when we receive those, we're going to go ahead and we would debit tickets. Let's say they give us 2 tickets that are worth, $100 each or something. We go ahead and we debit tickets for $200. We credit contribution for $200. Okay, now that's when they come in. Okay, now what happens? Then we hold the silent auction and they get bid up for $300. Well, now what do? Well, we're going to make the people pay us cash for those of $300. We will credit tickets for what? 2, and we will credit contribution for $100. Okay. And so this is when they are received, they come in, okay? And then they are revalued upon their sale as part of the fundraising appeal. The difference between the fair value at the time of the donation and fair value at the time of sale is accounted for additional contribution. Is that what we did? Okay, so go ahead and flashcard that. Okay, good. Come down and we start talking about contributions, okay? And really the discussion here is uncollectible contributions. What should we do? Okay, this is kind of mislabeled here in my opinion, okay? And that what we should really be taking away from this is how to handle an uncollectible contribution. And notice we do what? We reduce revenue by the uncollectible amount, reduce our contribution. this is how we handle typically non-exchange transactions, right? Isn't this the same thing we did for government? We reduced the taxes, the tax revenue by the amount we thought we weren't going to collect. Okay, so you reduce the contribution revenue by the uncollectible amount. With me so far? Okay, now this gets a little bit tricky, guys, and you got to be careful. Okay, and I'm not going to ask you for a flashcard on this. This one I will, for uncollectible amounts, reduce the contribution revenue by the uncollectible amount. I'm not going to ask you for a flashcard on this because I just want you to remember this is why you came to class tonight. Okay, if it is a service that's being provided, then I take bad debt expense because that is what? That is an exchange transaction. If you have exchange transaction, there's amount you think you're not going to collect, that becomes what? That becomes a debit to the, accounts receivable, credit to the revenue gross, debit to bad debt expense, credit to allowance for the amount you think you're not going to collect, right? Okay, so you've got to be careful as to what it is you're dealing with there. Are you dealing with a contribution, or are you dealing with a service that's being provided? Okay, good. Come over. We don't need all that. Let's look at fundraising. Okay, and what happens when a not-for-profit offers premiums such as calendars to donors? Part of the fundraising campaign, the cost of the premium is a fundraising, a support expense, right? So if you want to make a doggy calendar so that every month somebody sees a poor dog there and remembers they need to give money to save the canines, then what? Then that cost of creating that would be fundraising. The cost of premiums given to acknowledge donation, okay? So even if you're not selling it, maybe you're simply doing what? You're giving that, hey, give us a $10,000 donation, you get a calendar. Well, that's going to be what? That's the cost of that calendar is fundraising, okay? Then they tell us that generally the difference between contributions made and the fair value of any premium transferred is classified as contribution revenue. So what happens here? Let's say I was dealing with a not-for-profit one time, and there was a person that I worked with that I decided to get on the board of directors of this not-for-profit because he worked for Bank of America. And I figured if he worked for Bank of America, he might be able to get us some money for the not-for-profit. So that's why I want him on the board of directors. So he shows up to the first board meeting, and this guy's name was Joe Baez. Joe was no fool. He could figure out things well ahead of others. So he shows up to our first board meeting where he's a board member. He says, well, I'm glad to be here on the board. He says, I want to pay my dues. And he reaches into his pocket and he pulls out a $5,000 contribution from Bank of America. Will this cover my dues? Well, yeah, the dues was only what, $50? Okay, so what happens? We would have the total contribution received is what? $5,000. The dues that were sort of waiving for him at that point is what? $50. And so the contribution revenue is what? $4,950. Okay, so you would have to break out that journal entry, debit cash 5,000, credit dues, fees 50, contribution revenue 4950, right? In that example. Okay, good. So go ahead and flashcard that example, or not example, but that point. Okay, good. Now we're going to look at industry specific. We're going to look at educational institutions. We're going to look at healthcare organizations. And yeah, that's the main two ones that we're going to focus on. Now, we tend to focus on revenue here. Okay, our focus tends to be on revenue for these. Okay, so let's take a look and see what happens with revenue for educational institutions and revenue, and this is true revenue now. These are what? Exchange transactions, student tuition and fees, government aid, grants, etc. Now, if it's gifts and private grants, that could be considered a contribution. Now, one of the things the CPA exam likes to ask about, and I guess they think they're doing you a favor since you're a college student, and so you should know that if you have an assessed tuition and the class is canceled, they'll give you your money back. You know that. But no, guys, and that's where it gets a little disturbing, a little tricky, is that that's called gross revenue after any money that's been returned. So it's a little bit different. You think they would call it net revenue, but think of it like sales returns. Okay, but they call that gross revenue from tuition and fee after you backed out any amounts that have been returned for for cancel classes. Then if there are scholarships, etc., those can be either considered expenditure or as an allowance reducing revenue. So in that case, then it would be treated like what? Like a sales discount. You back it off of the gross revenue, or you could show it as an expense. That's an option that FASB gives entities as to how to handle those. Okay. Okay, good. Now you come down and we talk about hospitals, healthcare organizations, and let's take a look at patient service revenue. Okay, and patient service revenue should be accounted for on an accrual basis at established standard rates, even if the full amount is not expected to be collected. Okay, now they tell us that it's recorded on a gross basis, net of deductions. Okay, so what are deductions? Charity care. Okay, charity care is not recognized as a receivable or as a revenue. Charity care is not a bad debt expense. So flashcard that. So if somebody is injured, the hospital can't and won't turn somebody away, right? They bring in somebody and they say, well, let's see your insurance. Oh, we're not going to help you. Okay, so they're going to do that. One time I worked as a housekeeper in the hospital, and I heard a story that the nurses went on strike and they were all out there picketing, and then somebody just so happened to get injured out there in the street, and all the nurses threw down their picket signs and went and rushed the person into the emergency room so they could be taken care of. So, mission is sometimes more important than business, right? And so charity care is not going to be recorded as a revenue. It does not generate a bad debt expense. Okay, now deductions that could be made, okay, to continue on, and contractual adjustments for third-party payments is another example that will be deducted to arrive at net patient service revenue. So what happens? Even though the hospital may charge, $10,000 for repair of, say, a broken leg, different insurance companies have different rates. Okay, if Blue Cross going to have a different rate because they negotiated that rate. That's why some people felt that if we had a single payer system in the United States where just one payer paid, the federal government, that would drive down the cost of healthcare tremendously. But insurance companies have a tremendous lobby, and that's why the best thing you were going to get was something that happened like Obamacare, where you have all these different, what they call that, the different exchanges that set up to provide healthcare. Now, all of that was a complication that was generated by the fact that they don't want one single payer, and the insurance companies, to their defense, I guess, were protecting their own interests when they lobbied for that. And so that was the best you were going to get there. Okay, so you would go ahead and make that adjustment, even though it's 10,000, you would reduce that if the cost that's paid for the Blue Cross is willing to pay the hospital for that is only 7,000, and the person has Blue Cross, then you would have to back off that 3,000, right, to bring it down to net service revenue of 7,000 in that example. Now, we really have three categories of revenue here. We have central transactions, including services such as doctors, surgery, recovery, etc. Just call that operating revenue. And I know it sounds funny. You mean operating like surgery? No, we mean operating like operations. Okay, that's considered operating revenue. Okay, now you come down a little bit and they talk about other operating revenue. Okay, so other operating revenue is our second category. Okay, so we have what? We have number one is our regular operating revenue. Number two is what? Other operating revenue. And some hospitals like, what is it, UCSF, are teaching hospitals. Okay, so situation like that, there would be tuition, okay, gift shops, okay, cafeteria, those kind of things. In fact, donated supplies and equipment. Why don't you go ahead and flashcard these other operating revenue? Just flashcard them all, guys. Non-operating revenue, okay, that's really our third category. So we have three categories. Non-operating revenue are things like investment revenue, donated services, okay? So go ahead and flashcard all of that. Donated services are considered non-operating. So I don't know, the nursing staff, we call it, donate their time, okay? Well, it's a specialized skill. We're going to do what? Debit expense and credit what? Credit non-operating revenue, I should say. Okay. Okay, good. So guys, I know that I asked you to flashcard the specifics under there, but notice the three categories: patient service, other operating revenue. Okay, patient service is operating. And then we have other operating. Okay, and non-operating. Okay, good. Let's take a look at a couple questions here. Okay, looks like most of us have had a chance to look at this. Okay. So let me go ahead and in the poll. And most of us got it right. The answer here is D. Okay, but let's just go ahead and let's look at this one together. Okay. And we have cash contribution of $875 to be used as the board's discretion. Is that with or without?
Without.
Good, that's a without. So I'm just going to put a little WO there. I'll use WO for without and a W for with. A promise made to contribute 500 in year 8, this is year 7, if it's going to be in year 8, is it restricted?
Yes.
It's restricted as to what? Time, isn't it? I will report it at present value, and I'll have to put it in the with donor restriction column, okay? So when you make that realization, I'm just putting a D there, A and C are out, aren't they?
Yeah.
Okay, so now you look at the choices and you see that, hey, it's B or D because those have the 500,000 there, and that's pretty easy. So how should I handle this contribution of legal services? Is legal service a specialized skill?
Yes.
Okay, if your attorney ever calls you to wish you Merry Christmas, don't call them back or they'll charge you for that, right? Okay, so that's a professional skill. Okay, so what happens? You sit there and you say, well, look, if that's the case, I have to do what? I have to debit, and this would be what? Professional expenses or whatever for the 100,000, and I have to credit what? Contribution. And yeah, the contribution in this case would have to be what? Would have to be, and I can't, there's no 600,000. In fact, they want to make this question more interesting. They could have put 600,000 down here, but this is an expense because what? It is a professional service. Services are generally expense, right? I mean, typically services don't generate a future economic benefit. But anyway, I didn't have to worry about that because there's no other way to get to the answer without including, once you realize you have to include it as a contribution, they would come in without donor restriction, right? Okay. Okay, good. Let's take a look at number 2. Okay, good. Let's go ahead and let's take a look at this one. And just about all of us got it correct. The correct answer here is C. And remember, we said that when it comes to a contribution, okay, you're going to recognize the contribution revenue net of the uncollectible amount. Okay. So when they tell us they received 10,000, PICA anticipates 90% of this full 100,000 will be collected. That's their experience. Okay. So if that's the case, we take the 100,000 times what? 0.1, that gives us 10,000. We would go ahead and debit pledges receivable for the full 100,000. Credit what? The allowance for uncollectible pledges, 10,000. And then we would credit what? Contribution for the 90,000. The answer to the question. Okay. Okay, good. Now compare that, and I'm going to go through this one with you guys, the number 4 down here. I'm going to go through this one with you together. We'll look at it. Okay. Compare this to what? hospital, not-for-profit with no government affiliation report the following. And we have what? We have revenues, we have provision for bad debts, we have difference between established billing rate. So now we're talking about what? Patient service revenue. This is a what? This is an exchange revenue, isn't it? So now we would what? Take the revenue gross for any bad debts and what? And take an allowance of bad debt expense for amounts we think we're not going to collect. Okay, so they want to know what should be reported as net patient service revenue here. So they tell me the gross 775,000. Okay, how about this provision for bad debt? Should I, oh, well, let's look up here first. Note this figure includes 25,000 for charity care. Okay, what should I do with that?
Subtract it.
Subtract it. Good. Charity care is not going to be recorded as part of my net patient revenue, right? So I take it out. Okay, good. How about the provision for bad debts?
Subtract it.
I do not subtract it because I do not reduce my revenue by uncollectible amounts. I will report the revenue gross and I'll take a bad debt expense. So what I would do with that one is I would debit what? Bad debt expense for 15,000 and credit the allowance for 15,000. I don't reduce the revenue by the amount I think I'm not going to collect when I'm dealing with an exchange transaction like patient service revenue. If it was a contribution, Michael, yes, then I would subtract it, right? Okay, so I leave that alone. That's a distractor. And then difference between established billing rates and third party. Yeah, I do take that off, right? And so when you do the math on that, I believe you get 680,000. Question? Okay. We're getting later in the year. Right, earlier in the summer, we would have had a full set of lights on us. Okay, all right. Okay, good. Now you come over and you take a look at this next question. I'll let you do this on your own. Any question on that one? Okay, let's go ahead and look at this one. Okay, good. Everyone got this one right. If there's a donation of materials, that is considered a other operating revenue. Good. Okay, and I think I had you flashcard all of those just in case you get a question on the exam where somebody, wants you to answer something, which I think is a little granular for the exam. But if they ask us that, we got a flashcard for that. Okay, good. Come over. And when we get to module 4 now, I'm going to go to the slides. Okay, we have some slides set up for that. Okay, so let's just go over. And there's one thing I'm going to show you from the textbook here in a couple of minutes. And then we'll go to the class questions. But let's start with the slides. Okay, so what am I doing here? Close that, get out of full screen, go to the slides, and let's see. Let's start with so we're going in the order that's in the book right now for this, although the we've already talked about the slides dealing with the split interest agreements, but let's just go ahead really and look here, and they're going to make me unfurl the slides, which is irritating. Okay, now what happens? Let's say we have a situation in which I am United Way. And what happens? You have as your part of your payroll deduction program at your work, where you can give the money to United Way. Okay, now what happens? What they'll do, and they used to do them on these long sheets, now it's probably all done online, but you go online and you tell United Way, well, I want $100 per paycheck taken out, but I want that money to go to Save the Canines. If that's the case, you have not granted United Way variance power. They have no variance power because they have to give that money to United Way, don't they? So what they would do in that situation, they're the intermediary. They're going to what? They're going to debit cash, and they will credit a liability called, refundable advance or something like that, or liability due to Save the Canines, whatever it is, but it's going to be a liability to them. Okay, because there's no variance power. So key term there is what? Variance power. Okay, now you come over and the beneficiary would recognize the contribution. So Save the Canines would do what? They would take the contribution. So it's a liability to the what? To the recipient. To the beneficiary, it is what? It is a revenue because they're going to get that money. Okay. Now you come over and if you give United Way variance power, okay, now you tell United Way, here's the money, give it to any of the not-for-profits you work with. Well, if that's the case, then what? The recipient, United Way in this case, would debit cash, credit, contribution. Save the Canines would be sitting there saying, well, I hope that what? That United Way will give me this money, but since they don't know, they make no entry at all for that because they are not sure that they're going to get that money. Now, another situation happens is if the intermediary is a financially interrelated with the beneficiary organization. For example, you give your money to the Golden Gate Foundation. And the Golden Gate University Foundation, it's a separate entity, but it is what? It is bound to give its money to what? Golden Gate. If that's the case, then what? Then they would have to they could recognize that as a, the intermediary could recognize that contribution as support revenue rather than a liability, even though they are bound to hand that off to the university. Okay. Okay, good. Now you come over and you take a look at this discussion here, and we say, and I'm now giving it to you in the context of information that's a little more CPA review oriented. And so principles here, when you deal with the situation, are largely driven by the application of the concept of, as we've learned, variance power. We consider the common situation of a foundation, the recipient, which raises money for another not-for-profit, the beneficiary. Okay, now again, if it is without variance power, the recipient will do what? The recipient will debit the asset, usually cash, credit the liability, right? They're calling it refundable advance here. Okay, now I go see item B on the next page, and because I want to show you what the beneficiary does in the without variance situation, so we come down to item B, and if it's without variance power, the beneficiary does what? They take the contribution. Okay, the person that's going to get that money takes the contribution. Now, if we are in a situation that it is what? With variance power, and notice I put up there a tag for recipient. The recipient will debit the asset credit contribution, that's United Way. And the beneficiary, say the canines, does nothing because they don't know if they're going to get that money or not, right? Okay, they'd have to wait for United Way to tell them you got some money coming. Okay, good. Investments. Okay, investments, we do not have the categories: trading, available for sale, held to maturity. Everything is treated as though we're trading. So what do? We mark these securities to market on the balance sheet each period, and we take any unrealized holding gains and losses directly to the statement of activities. There's no other comprehensive income. Okay, now you come over and you take a look, and they are reported at fair value on the income statement. Realized and unrealized gains and losses go to the statement of activities. Dividends are what? Are treated as a revenue. There is no equity method, etc. Okay, so everything is like it's a trading security, right? Bottom line. Okay, good. So with that, we've already talked about split interest agreements. So what I want to do now that we've looked at that is go back to the textbook, and I want to show you one little wrinkle that you might see some questions in your homework. I doubt that you'll see anything like this in your exam, but I want to show you this so you don't start freaking out on your homework if you see something stupid like this. Where is it? Where'd it go? Okay, I guess they got rid of that. Okay, good. So I guess they got rid of it because where's the investments discussion? I guess they also decided that it was equally stupid as I did because they got rid of it. Okay, so you really shouldn't be seeing a whole lot of discussion there on how to handle those when there is some sort of situation where there's a restriction as to the use of the investment. So what I want you to do at this point is look at these couple of questions, okay, as to how to handle the investments. And it's really what we've already talked about. So there was something there that was there before that they got rid of, which is good. Okay, good. Looks like most of us have had a chance to look at this one. And they give us all this information about what it had originally been purchased for, right? Collation, received a gift of treasury. The cost of the donor was $20,000. We don't care. We recorded at what? At fair value at the end of the year is what we said, which is the 15,000. Okay. These $500 brokerage fees that were paid by the donor is of no consequence to us. It's fair value at the time of transfer, and that's what it will be reported at. And then year over year, we'll just keep reporting that at fair value. So the answer here is the 15,000. Okay, good. Let's take a look at the next one. Okay, let's go ahead and let's take a look at this one. And most of us got it right. It is 115. So let's take a look at how we got to that for this one. And we can see that RST Charities received equity securities valued at $100,000 of a gift without donor restrictions. Okay, so when we get that without donor restriction, I'm going to put with over here. WO is without. We get 100,000, wouldn't we? Okay. At the beginning of year one. During year one, RST received 5,000 in dividends from these securities, and the securities had a fair value of 10,000, and they don't tell us anything about restrictions on the dividends, and they don't tell us anything about what increases in fair value and how those should be handled. Okay, so let me stop sharing. Something's in the way. Okay, so they don't tell us that it has to be used for some special purpose or anything. And those increases in fair value, that's going to be a gain. The dividend is a gain. So they say, by what amount did these transactions increase? And they ask the total anyway. They don't say without. So we have contribution revenue of 100,000. We have 5,000 of what? Investment revenue. We have what? 10,000 of investment revenue from the increase in fair value, right? All go to the statement of activities. And so we have what? The 115,000, the original contribution. The dividend that came in is a revenue, right? And the increase in the investment is a revenue, right? Right. Debit investment asset, whatever it is, the stock, 100,000. Credit what? Credit cash, For the dividend, love how the pen decides to stop writing right while I'm trying to explain something that might not be the clearest thing in the world. Try to go back to full screen, see if that helps. Okay, debit cash 5,000. Credit what? Credit the investment asset for the increase in fair value, right? When it originally came in, it was for 100,000, but now it has increased 10,000, hasn't it? And so I'm going to put contribution revenue 100,000, investment income, whatever, for the dividend 5,000, and my gain on investments, whatever, is going to be 10,000. So all of that's going to be an increase in my, and it so happens by the reading of this question without donor restriction, but it doesn't really matter because they didn't ask me with or without, right? They just asked me the total. Okay. Okay, we're obviously not going to get to the next half of governmental. So now the big question becomes, what do you want to do for next time?
For me, my preference, if it works for everyone, I'd prefer just to do next Tuesday.
Next Tuesday works for me.
Are we doing module 10 or final review?
Well, I think under that scenario, we set aside another 3 hours. We would have time to complete the rest of governmental and pick a topic for final review that maybe you'd like to spend more time with. I wouldn't recommend governmental or not-for-profit since we kind of spent some time with that. But outside of that, I'm thinking for the governmental, let's do this, guys. Let's make me stay committed to keeping it about an hour for the rest of the governmental, and that'll give us 2 hours or so of final review. Unless you want to do 4 hours next time, we do 4 hours, we'd go what, 5 to 9? That would give us more time.
Good.
It's all voluntary, so.
Yes. I wonder what happened to all the class. They don't need to understand this material.
I don't
They're
care.
smarter than us, apparently.
I don't bother myself with that kind of stuff.
So does that mean just us taking the test?
Now, what do you want me to start looking myself in the mirror? Oh God, I'm so ugly. The class did. Who cares? I don't care. That's their problem.
Do you have module 10 marked up already?
I do, but not in a manner that I can share with you. I have it marked up in my book.
Oh, I was gonna say, maybe you could send that and we could like go off your notes or look at a past recording or something and do that ourselves and then do the whole.
I mean, you could always watch. You could always watch whoever it is. I think it's probably Garrity, and the book has a markup.
Yeah.
You can always do that. I'm completely open, guys, whatever you want to do. And you don't have to answer now. I mean, it's just the 4 of us, so we can, when I say I'm completely open, I don't want to talk about governmental and in the final review book, because we've already done that, but although I could, anyway, it's up to you. 3 hours, 4 hours, not the rest of that governmental. I can't mark up the book ahead of time because if I save the file, then it's already marked up. And I'm here to tell you that if I just put a marked up file on the screen, the learning stops because all you're doing is just rushing to put the markups on the page. That doesn't work.
It's true. Maybe we just shoot for 4 hours and I guess if we get burned out before then we quit or whatever.
I'm okay with 4 hours.
Yeah, let's do 4 hours. So we finish everything so we can study.
5 to 9?
Yes.
Yeah.
Pacific? Okay, and so what we'll do is, so here's what I do need to know though. We'll do that governmental piece that's sort of missing, right? And then the balance of the time, you got to tell me. But you got to tell me in advance. I don't do CPA review instructor dunking tank. You know, let's see if we can stump them on this one. So it's going to have to be so I can prepare. But you don't have to answer that now. Just tell me, send me some emails and suggestions. Or you want
Could you pick like the 3 what you feel like are the most important or heavily tested topics?
I can pick, yeah.
Yeah. Why don't
I
you?
mean, I don't know. I've never
Okay.
taken this test
I
before.
trust your experience.
Yeah,
Okay, I'll pick.
and whatever.
But if you start looking at stuff and you're like, oh shit, yeah, I absolutely want it, then just tell me. Okay, but I can pick, yeah.
It's
Thank
always
you for taking-
confusing how in the final review, it doesn't follow like the order of the book.
It does not.
That's really annoying.
Yeah, it's kind of annoying, although I think really, I would say my personal opinion is that, you know, when we negotiated this package with Becker at Golden Gate, they were going to give us additional questions as part of the package. And I opted for final review instead. I changed that so that we get the final review book, because I believe that final review, if you look at the how to study file, it's a self-contained thing that you should look at by itself. So I think it's okay that it's not in the order of the book and that it's listed the way it is. And you should, although you don't have to watch the lectures and stuff at final review, I think you should work all of the multiple choice questions and all of these task-based simulations in the final review material in your software. You know where that is, right? You should be doing all of that part of the exam, and you might want to start looking at that how to study file. And then we'll go through whatever we have time for that I select or that you request together next time after we do the governmental from the book.
Okay.
Don't watch their lectures in the final review.
So
Waste of time. They start that, hey, boys and girls stuff again, and it doesn't, I don't believe that it's helpful. But the material itself, the problems themselves, yes, I think those are very good.
so the nonprofit we finished today, right? Everything's finished?
Yeah.
Nonprofit?
Well, I didn't do underwater investments because we're running out of time. You want me to do that real quick, or you want to go?
Can we do it quick?
Where is
I mean,
that?
how about you guys? I'm sorry.
We can do underwater. So underwater endowments, basically what's happening here is somebody gives me a stock and they say, hold the stock in perpetuity. You got to hold it forever. That's what we mean by an endowment. Well, what do I do if this stupid thing starts dropping in value? They told me I had to hold the stock forever. Meanwhile, the thing is dropping in value. What am I supposed to do? And so for underwater endowments, we have to make disclosures, which is what is the fair value of the underwater endowment? What was the original gift? And what is the amount of deficiency of the underwater endowment? And they do give us a decent pass key on that, which gives you the mnemonic FED. And I think that is helpful because the federal government did start saying that entities have to disclose this. I think maybe it had something to do with Trump or something. But anyway, you take a look at what they talk about here, and that's exactly what they do. They say, well, look, here was the fair value at the time of the gift. Here was the original gift, and the deficiency is what? 250,000. So that someone can see that even though we would still be required to kind of maintain that $10 million of value on that, we would be showing that these gifts are actually underwater at this point in time. Okay, so you would have to go ahead and disclose those items. So that's really kind of why I had gone past that a little bit. I think it's pretty self-explanatory, but that will now complete the discussion of not-for-profits, Serena. Okay,
Thank you.
okay, guys. I will see you next time.
Thank you.
And
Have a
thank
good
you
night.
for taking the extra time.
Okay.
Thank
thanks,
you.
guys. Yeah, thanks for your enthusiasm. We'll see you soon.
Have a good night.
All right.